Welcome back to The Explainer. Today, we're putting on our equity research hats and conducting a full financial autopsy on Barrett Business Services. We're going to uncover exactly why a fundamentally stable, dividend-paying company suddenly saw nearly a fifth of its value wiped out in a single trading day. But before we get into the weeds, disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's dive into the data. Here's a quick roadmap of where we're headed. We're going to break down that brutal 18% drop, analyze a major Q1 tax hit, look at their Q2 margin pressures, and then contrast some fascinating trading data before we zoom out to the long-term fundamentals. So let's head straight to the scene of the incident, August 6th, 2026. Now, here is the ultimate puzzle we're trying to solve today. If you're acting as an investigative journalist of financial statements and you look purely at their top-line revenue, this 18% plunge literally makes no sense at first glance. The company was actually growing its sales. So what exactly triggered the trapdoor? I mean, the scale of this sell-off was intense. We're talking over $4.2 million changing hands in a single session. That kind of massive volume, that screams severe market panic, and it created a huge divergence from how this stock historically behaves. And when you look at the chart, a pretty wild tale of two timelines emerges. Over the last 12 months, the stock has just been taken to the woodshed, down nearly 25%. But if you zoom out to a 5-year horizon, long-term holders are actually still up a really solid 73%. To figure out why the short term is bleeding so badly, we have to look under the hood of their quarterly reports. Let's rewind a bit to the first quarter, right where the initial cracks started showing in the foundation. This number right here is where the pain really started. Bam! An $11.6 million non-reoccurring charge out of nowhere. The company caught a bad break with an adverse U.S. tax court decision regarding prior year tax credits that spanned all the way from 2017 to 2022. Just a heavy, unexpected blow to the balance sheet. Look right under the surface here. You can see Q1 revenues were actually looking pretty good, up 5% to $307 million. But that staggering $11.6 million tax hit, it acted like a giant anchor. It completely dragged their bottom line down, expanding their net loss to $14.8 million, compared to just a $1 million loss the year prior. Now, as an equity analyst, you can't just read the headlines. You've got to dig into the actual SEC filings, like this consolidated statement of cash flows. This is crucial because it shows you exactly how these operating activities, these massive tax liabilities and payroll adjustments are directly draining the company's real cash position in real time. Okay, so they took a hit in Q1, but moving chronologically into Q2, we find out things got a little more complicated. On paper, the top-line scale was still a total beast. BBSI managed to push their Q2 gross billings up 3% to a massive $2.29 billion. Billion with a B. But, as we all know, it's not about how much you make, it's about how much you keep. And that top-line scale was severely contrasting with their bottom-line struggles. Because here is exactly where Wall Street totally lost its patience. Even though revenue climbed to $319.3 million, net income dropped significantly, falling from $18.5 million in 2025 down to just $12.9 million. This resulted in an earnings miss. They reported 52 cents a share, missing Wall Street's estimate of 56 cents, and the market punished them for it. So what's squeezing the profits? Well, this margin compression was driven by some very specific macro headwinds. They faced broad client hiring softness, mostly due to geopolitical uncertainty. Crucially, they got hit with a sharp rise in workers' compensation claims, particularly in the notoriously difficult California market. And perhaps the biggest red flag? Their specific staffing revenue segment plummeted by 18%. Now, to be fair, management isn't hiding from this. CEO Gary Kramer came right out on the earnings call and acknowledged the pain, stating they expect 2026 to be the absolute trough for their margins. They are raising prices to combat these costs, but it just takes time for those cumulative pricing adjustments to actually flow through to the bottom line. Now, this next part, this is my favorite piece of the entire puzzle. We've got a classic tug of war happening behind the scenes. we are seeing a massive, massive divergence in how people are trading this stock. On one side, the institutional smart money, your hedge funds and asset managers, they are dumping millions of dollars of stock. But on the exact same timeline, BBSI's own C-level executives are actively buying shares with their own cash. The scale of this institutional exodus is heavy. Data shows 88 different institutions cut their positions. Big players, too. GW&K totally liquidated a nearly $15 million stake. Point72 dropped over $7 million, and Millennium pulled over $4 million. The smart money saw the margin squeeze and slammed the sell button. But here's the twist. Defying that institutional panic, company insiders are stepping up. Over the last 6 months, insiders executed more buys than sells. The standout, President and CEO Gary Kramer personally dropped over $225,000 into the stock. Look, when the CEO's buying the dip, it usually signals a strong internal belief that the market has completely overreacted. So we've looked at the quarterly chaos. Let's zoom out and look at the actual fundamental structure of this business over the long haul. It's so easy to get caught up in day-to-day trading panic, right? But check out this timeline. This shows an unwavering, rock-solid commitment to returning capital. They've maintained a steady 8-cent quarterly dividend through all this recent turbulence. In fact, BBSI has a remarkable 21-year streak of consecutive dividend payments. You don't get that kind of consistency by accident. And it goes way beyond just the dividend checks. In just the first 6 months of 2026 alone, between aggressive stock repurchases, basically buying back their own stock on the cheap, and those regular dividends, they returned over $39 million to shareholders. How are they pulling that off during a margin squeeze? Because they have incredible financial flexibility. Look at this. 0 debt. Absolutely zero. Plus, they're sitting on nearly $68 million in unrestricted cash and investments as of Q2. That fortress balance sheet acts as a massive shock absorber against these macroeconomic headwinds. Which brings us to the ultimate metric for any equity analyst, free cash flow. It's the lifeblood of the business. It's the cash that's truly available after keeping the lights on. For BBSI, despite the tax hit and the margin compression, their adjusted free cash flow remains healthy enough to easily support both their aggressive buybacks and that steadfast 21-year dividends. So let's synthesize this autopsy. Is the stock undervalued or overvalued today? Well, if you look at the fundamental cash position, the complete lack of debt, and a 21-year dividend moat, they are structurally incredibly sound. Their economic moat, built on sticky client relationships and efficient scale, seems intact long-term, despite the current California workers' comp headwinds. The institutional sellers are clearly pricing in a prolonged, painful margin squeeze. But the executives, they are betting their own money that this is a brilliant time to buy an irrational dip. The data is all right here, but the real question is, which side of this trade are you on? Do your own homework, and we'll catch you in the next explainer.